Hello, everybody. Welcome to another episode of Simply Finance. I am Shane White, your host, and this is episode 49. If you haven't listened to my recent interview with John Fosco on episode 48, I would recommend going back and listening to that one next, as he had a ton of valuable information that I think could be really helpful for a lot of you investing this week in the market. So I'm just going to kick it off today with a little bit of market performance. The markets have started off back and forth this week. Today is Tuesday, and today is a very green day in the market. So the Dow's up 3%, the S&P just over 2% up, the NASDAQ is at 1.78%, and the Shane Index is trailing behind ever so slightly today at 1.54% up. So pretty good across the board. I think there's a lot of interesting news, as always. I mean, ever since I've started the podcast, it seems that there's never a lack of news that's affecting the stock market. So my strategy right now is just I'm continuously putting small amounts of money back into the market, either weekly or bi-weekly. And not that, I am no hedge fund manager, but I think my strategy is going to be something that's going to mirror a lot of what I've read a lot through Warren Buffett's teachings. So I'm just trying to, I say this all the time on the podcast, but I'm truly not trying to time the market. What's more important to me is time in the market. So with partial shares and the capabilities of partial shares and zero commissions on all trades through Robinhood, I'm really just trying to be consistent at this point, especially with all the uncertainty between COVID and different things with the protests for George Floyd these days. There's lots of uncertainty when it comes to investments, but I think the one consistency that you can do is just slowly but surely keep adding to the pie. So that is what I'm doing. And before I jump into today's topic, I hope everyone already notices a big change in the podcast. If you're not watching on YouTube and you're listening just in the audio form, I'm hoping something sounds different. I finally, after tons and tons of feedback from a lot of you on how poor and shitty the audio quality was, I invested in a better setup. I hope this sounds a lot better for all of you. I apologize in the past for the, pop of the P's and the annoyances that come with a poor quality microphone and no windscreen. So I added a few things here and hoping the sound quality is much better than it was before. So today, what are we talking about? I'm not interviewing anybody today. This is just a one-on-one with me. So if this type of podcast is not of interest to you, by all means, you can skip ahead to, one of the other interviews I've done. I've done, I believe, 5 now. So today, what we're talking about are warrants. And when I say warrants, no, I don't mean when you're doing something you're not supposed to and you have a warrant out for your arrest, but it's a different kind of warrant, a warrant that is meant for investments as an investment vehicle. And I'm going to chalk this one up. This is one that I've wanted to do my research and do a podcast on for a little while, but I got a question from a good friend yesterday on them. So I had to do the research to answer his question because I honestly didn't know. And we're going to jump right in. So what are warrants? Warrants essentially are similar to options, but with some really key differences. And usually a warrant, as you get into investing and start trading, you'll notice that obviously a lot of the ways to buy any of these investment either stocks or bonds are done through a secondary market like an index, or like really you're buying it from the market, right? With a warrant, they're not, most of them, not all of them, but most of them are not traded openly on the market. Some are, and we'll go into that in just a little bit, but really most of them are actually issued directly from the company who is giving out the warrant. So it's a direct issuance from the company. And honestly, most people that receive warrants are either someone who works for the company. So this could be a way for a company to incentivize their employees. Or a lot of times, warrants can also be given to early on investors before they go public. This is one way that warrants are then given out or earned, per se. A huge difference between a warrant and an option is the lifespan. So if you guys have started to look at options, we've done a few podcasts around the general themes of options. And if you've looked into those by now, you'll notice that an option really is exercised for the most part, within 2 years from today's date. You normally won't see options beyond that time frame. A year and a half to 2 years, really. Warrants, on the other hand, have enormous lifespans, and some warrants can even get up to 15 to 20 years in length, which just means that you have the ability to wait 15 or 20 years from the date you get the warrant until you have to either exercise or not exercise the warrant, which is powerful. It can create a lot more risk, but it also can uh, be a way, if you are able to get your hands on one, it gives you some long-term strategy on when you can expect to exercise those and hopefully make money off of them. So what is a warrant in its simplest term? So really, a warrant is a promise from a company that you can exercise at any point in the future before the exercise date. So like I said, if the exercise date on a warrant is 20 years, today is June 16th, 2020. So I would have 20 years to exercise the warrant. So I have until June 16th of 2040 to exercise that. And what happens is when a warrant is exercised, instead of you just getting shares of a stock that are already traded in the market, the company actually is going to issue new stock for you. So if I owned one warrant, I decided to exercise it, the company actually has to add a new share, which is what's called dilutive. And dilutive, just think of, when you're diluting anything, it means that if there were 100 shares in the market and you were just someone who had bought this share on the open market, you just bought a stock. Once someone else exercises the warrant, well, now I made that company create a new share. So now there's 101 shares in the market. So now the share that I had owned before that warrant exercise time is now not worth as much as it was right before. So it's dilutive. It makes the pool of the shares that are currently in the market worth slightly less when a warrant is exercised. Really, when it comes to warrants, they're not talked about a ton anymore in the US. They used to be a much bigger thing a few decades ago, but you do still see some pop up from time to time. One of the things that while I was doing my research, I noticed was that I think a lot of companies kind of moved away from them because of the unwanted potential risk that comes with having warrants out on the market, right? So, um, unlike like a bond where once you reach the maturity date on a bond, that money is guaranteed, or the company knows once the day they issue the bond, they know when that bond expires how much they owe on that bond. Technically, with a warrant, it's kind of backwards. So what happens is, and I'll walk through an example here shortly that'll do a better job of explaining this, but when you when you exercise your warrant, that company owes you a share. Instead of you having a guaranteed price that the market value is worth. So, obviously the stock price is constantly changing, but your warrant value is fixed. And this will all make a lot more sense once I walk through the example here shortly. But on the company's side, not knowing how much a stock is worth when they go to give you this new share can be a very risky thing for a company. So that's really why they've kind of gone away. Now, they're not as common in the US, but I was able to find that they are actually pretty popular and pretty common in countries like Hong Kong, Germany, and a few other European and Asian countries. So they do still exist. Like I said, they're just not as common here in the United States. Warrants that do trade on open markets really are usually traded at a premium. And that's obviously because if you're someone who has the warrant and today you could sell the warrant, let's just say for $10, you're obviously going to want to make your cut. So you're going to sell it for a little bit more. That's pretty common. And I think that would once I walk through this example, I think this stuff will make sense. And then the one thing to remember with warrants they have a long lifespan, right? So like 15 to 20 years. As you get closer and closer and closer to that expiration date, the price of the warrant on the open market should continue to decrease. It's called decaying. So the price will really decay as you get closer and closer to that maturity date, because once you get closer and closer to that maturity date, there's obviously not as much time left for that stock to fluctuate up or down. But in theory, the hope is that it would be going up. And so the amount of money you could potentially make off of this warrant, basically it gets shorter and shorter and shorter. The upside of what you could make on it gets smaller and smaller and smaller as you get closer to the date. There are, like I said before, there's not very many warrants that are traded on the open market, but there are some. And if you do find a company who has warrants traded on the open market, the way you'll know if it's a warrant or just the stock is most warrants have the stock ticker symbol with a W on the end. So it would be like Apple, AAPL.W. That would be like a warrant from Apple. They don't have warrants, but if they did, that's what it would sound like. And that's kind of the background of warrants. I hope that all kind of makes sense. It's a little theoretical, and that's why I put together an example that we'll walk through next. And I think that will really help explain the differences between the two. So, okay, here's the example that I'll walk through for a warrant. So let's say it's today, it's June 16th, 2020, and you are offered a $10 warrant that's good for one share of company ABC. So, let's say you're an employee of company ABC and you've done a great job. So instead of giving you a bonus in cash, they give you a warrant. You get one warrant. Again, it's worth $10 and it has a 20-year it has a 20-year maturity date. So it's today, again, June 16, 2020. You have the warrant in your hands and you have until June 16th, 2040 to exercise this warrant. And again, this is like warrant 101. There's a little more complexity we could get into in a future episode, but for today, we're just going to keep it pretty simple. So you have your warrant and you have 20 years to exercise it. Now, let's just say the stock is volatile. It's always swinging up, it's swinging down. It kind of swings all over the place depending on what the news is that is tied to your guys' company ABC. And today, on June 16th, let's just say that the stock is trading at $8.50. Well, your warrant is $10. So remember, the warrant, what's important is, number one, the price of the warrant, which is what you'll have to pay to get one share. And then obviously what's always important is how many shares. So this one's worth one, and what the stock is trading at today, which I said was $8.50. So your warrant price today is actually above the price of the stock trading in the market. So if you were today to exercise your warrant, which would be a bad idea, and I'll tell you why, is because you would have to give, $10 to the company to exercise this warrant, and then they would give you one share of company ABC stock. Well, that stock is only worth $8.50 today. So it actually would have cost you $1.50 just to gain that share. And remember, you got this as compensation from work, so it shouldn't cost you anything. If anything, the hope would be that you can make money off of this. Okay, so that's today. So if you're someone who knows a little bit about warrants, again, I'm not any type of hedge fund manager by any stretch of the imagination, But I did do my research here. So this is, in this example, what I'm trying to say is that, if you did your quick research and just figured out what a warrant is, you would quickly see that you would not want to exercise this today. Okay, now we're gonna fast forward. It's 2 years from now, and you still have your warrant. You haven't exercised it yet. And remember, you had 20 years. So we're 2 years from now. It's June 16th, 2022, and you now have 18 years left until the warrant expires. Good news is it's been 2 years, and the stock has gone from $8.50 to $25 per share. So it's jumped drastically. Great things are happening at this company. You guys are up over 100%, and things are just moving and grooving. And you want to think about exercising your warrant. Now, in this example, you still have 18 years left on the warrant. Remember that. It's a really key component of this. But you could exercise your warrant for $10 a share. Now, you'd pay your $10 to get to exercise the warrant, and the company would have to give you one share. That share, however, is $25 today. That's what the price is on the open market. So right away, you paid $10 for something that's worth $25. Now you could do a couple things. You could obviously just sell it immediately back onto the market. So, the company gave you a new share that was given out because you exercised your warrant. You got that share, you turned around in Robinhood account and you sold it. You sold the share and you make $25. You paid 10, so you profited $15. That is something that is completely in your rights to do. And part of owning a warrant, you are totally allowed to do that and could do so immediately. Now, even though the stock is up to 25 from the 850 when we were issued this warrant, and our warrant's, a $10 warrant, if this is a volatile stock, and this is where warrants, it gets really interesting. Because it's a warrant and you have such a long time until it expires, you might want to take a step back and think about what the future could hold for company ABC. Now, if you feel like $25 is super overpriced and there's no way it's ever going to get higher than that, then maybe exercising it this early on in this warrant's lifespan makes the most sense. But like I said, it's got 18 years left. So if you think about the way stock prices fluctuate, and again, at the beginning of this example, we're saying that this is a very volatile company. Over 18 more years, this company could go up to $1,000 a share, right? That's totally possible. Or something horrible could happen and you guys could go bankrupt. Like anything is possible over that time frame, and you don't know what the future holds. And that's where the risk comes in with warrants. You obviously don't know, and you have to make an educated decision at some point. Now, if you hold on to that, and let's just say, let's go to the other side of the example. Instead of exercising this after 2 years, you decide that, you know what, I'm just going to wait until that last year and I'm just going to sell it at whatever it's at because I think it's going to go up. I think it's going to, we're going to quadruple in price on the stock market, and it'll be worth it to hold on. The closer you get to that exit, to the maturity date, the less this is worth in the open market. So if you wanted to go sell it, and now we're in, 2039, and let's just say the stock, holy cow, it had gone up to $350 a share. We decided to keep holding on to it, hoping it would go up to 500. It ended up falling down to $12. We're actually going to file for bankruptcy, we think, in the next year, and things are not looking good. Well, now you basically just lost a ton of potential money, but it could have also gone up if bankruptcy wasn't a thing in the future of this company. All of this is arbitrary. No one knows, but it gives you, what I wanted to explain was, it gives you a long horizon to make it the best possible decision from your perspective with your educated guess in your own research on when to exercise this warrant. So this person owning one warrant of company ABC, they could have done a couple different things, right? They could have hopefully not exercised this when the stock price was less than the warrant. Otherwise, they would have paid money out of pocket to own the warrant, when they could have just held on to see if it goes above the warrant price. The company could have gone up, and then they could have exercised it then and made money and held on to it. and then just own the share. They could have turned around and sold it right away and just made a profit from the warrant, or they could have waited all the way to the exercise date and seen what happens once they got closer. Any of those options are available. It's kind of a cool thing to diversify. It's kind of a, I shouldn't say thing, it's kind of a cool component that you could add to your portfolio to diversify just what you're doing, right? And then the other, it's one of those things where, especially if it's something at a company that you work at, it's pretty neat to be able to have an opportunity to have the power to hold on to a warrant until you see the time being right to exercise it. So I hope that all makes sense. Again, there's something that's not talked about very often, but in case you stumble upon them, I think it's a good thing to look at. Some of the newer stocks I've been seeing have warrants. It popped up because my friend was asking me about this, because Nikola, which is that electric truck company that I had talked about and invested in a few weeks ago, they do have a warrant. You cannot trade them on Robinhood today. Robinhood does not support warrants, but that is an example of one you can go take a look at. So it's nkla.w, and you can see the warrant that they currently have available on the market. All right, everybody, that's it today. I hope you all learned a little bit about warrants and how they work. And if anything, if you didn't know what warrants were, now you do. Thanks, as always, for listening. I can't thank you guys enough for continuing to support the podcast. And I hope you guys have a great day.